All right, welcome to the Monday Market Update with Nikki. It is January 26th, the last week of January already. Oh my goodness. How are you?
I'm doing good. I can't believe it's the last week of January. It's flown by like
Yeah.
crazy already. It's awesome. Well, I want to start out talking about mortgage interest rates as always. We are seeing interest rates down into the fives again, low sixes, depending on what you're doing and what kind of product you have. So that's the good news. So with the announcements of things that are going on that I'm going to be talking about, it hasn't really affected the market in a negative way, which has been actually really good for us from a steady standpoint. So I don't know if you remember me talking about last week and the last couple weeks about the Fannie and Freddie buying mortgage-backed securities or them being allowed to buy mortgage-backed securities. We talked about it being, Trump wanted to see them buy up to $200 billion in mortgage-backed securities, which if you remember right, I had talked about how when that happens, it should lower interest rates about a quarter. Well, come to find out, now that limit has actually been increased. So now Fannie and Freddie are allowed to buy up to $450 billion, so $225 billion each for those mortgage-backed securities. This is important because they probably won't do it right away, but it gives them wiggle room to do it in the future. So if something's going on with the Fed and they're not lowering interest rates at the rate that the Trump administration would like to see, he can then further direct Fannie and Freddie to purchase more of those mortgage-backed securities. That's just important for homeowners because it helps keep those interest rates low and helps put a cap on that market when they do start buying them. So at $450 billion, of course, we'll see a little bit over 0.5% decrease. Of the mortgage interest rates if they do buy the full capacity. So that's good news that's coming out of the mortgage industry right now. The other thing I wanted to talk about is Trump had made an announcement and put together an executive order talking about preventing large institutions from bulk buying properties because from what they are talking about is that when these large institutions buy out these properties, it doesn't give an opportunity for first-time home buyers to be able to basically have a chance at purchasing because the pockets of these large corporations are so deep that they'll always win out in the deal no matter what. The other side of the coin says that, well, it's actually good for first-time home buyers because a lot of these investors will put in money into renovations before they resell the home, and those renovations are too costly for a first-time home buyer to be able to do themselves or to be able to pay out of pocket for. So really, it's a way of just financing a renovated home versus having to do the work themselves. So there's two sides to this story. It'll be interesting to see how this unfolds and what ultimately happens. The prediction is that only about 3.5% of homes that are purchased in the United States right now are purchased by those bulk investors, and most of those are not going to be single-family homes. Most of them are going to be condos, things of that nature. So really targeting that investment property area. With that being said, depending on what you categorize as a large corporation, there are also smaller companies that are purchasing about 11% of the market right now. So those smaller companies would be like individual investors or what they refer to as mom and pop shop investors. So like anyone owning anywhere from, one to I would say 50 or 60 homes is really that bulk of the buying up and reselling and competing with other people in order to prevent or in order to compete in that single family world where the first time home buyer might want to be able to purchase. So it'll be interesting to see how everything gets laid out. Trump has ordered Scott Bessent to put the rules together on what this is going to look like over the next 30 days. So we'll have more updates on that.
Yeah.
Other things to watch out for this year. It's going to be a big year in the mortgage industry. Remember me talking about like a couple months ago about the Vantage credit score and how it's going to be different than FICO. So Fannie and Freddie are working on implementing that. That will happen this year. So we'll be following that story first and foremost and saying, okay, how is this going to work and how is this going to help and how do we operate under the Vantage credit score versus the FICO score. The other thing we want to watch out for this year is yes, there were just talks about doing a 40-year mortgage, but we're actually seeing some indicators that there may be an opportunity even for a 50-year mortgage coming in as a product. We will kind of, again, have to follow this story. These are all things that are going to be unfolding this year and things that I'm going to be watching closely as the stories develop and as the new things come out. But the 40-year or the 50-year mortgage, it's probably going to happen this year at some point, that it's going to come out and that to be a viable product. It'll be interesting to see how the interest rates are on that, to see if they are significantly higher than what you would get on a 30-year and if there is really any true benefit. Because keep in mind, even though you might span that loan out 10 more years, if the interest rate goes up enough, it might not make a difference from a payment standpoint. So we just have to keep an eye on that as well. Lastly, the story we're going to be keeping an eye on is the non-QM products. So back in the day, before 2008, there was a lot of opportunity for a homeowner to go in and do a stated income loan, a no document loan, things of that nature. Those were happening at a really, really, really rapid pace, which ultimately contributed to the mortgage meltdown in 2008. With that being said, since that time, those are what we call non-QM products or products where there's alternative documentation or less documentation. A good example of a non-QM is the DSCR for investment properties. In other words, the debt service coverage ratio. The rent covers the mortgage payment, you're good to go. That's really the best example of a non-QM, but there are also options where it is alternate documentation, such as using 12 months of bank statements. So for self-employed borrowers, using a 1099 as the income source instead of, and taking some deductions off of that, instead of using full tax returns, there's opportunity to do a asset depletion loan or using your large number of assets to deplete over the life of the loan to be able to qualify for that payment. So those products are not only coming to the market in huge amounts in droves, but they are becoming increasingly more popular, especially for people in my position when I'm trying to specifically qualify self-employed borrowers, i.e. realtors, for mortgages. They're very important for us to be able to expand on those because it opens the door for people who previously couldn't get a mortgage to be able to purchase homes. They're important for the market, and not only are they becoming more popular, but there's a huge push in the market because the interest rates are actually coming down for those products as well, which is is a huge deal for an alternative product for people to be able to qualify for that. So just those are three things that we're going to definitely be watching it for this year and making sure that we follow those headlines.
Wow, that's a lot. You
It's a
packed
lot,
that in.
yeah. A lot's going to
I
be
love it.
changing this year.
That's crazy. So I just wrote down a couple things. So for the people that weren't on the call with the Vantage Score, can you explain just a little bit about
Sure.
that?
Sure. So right now, when we qualify someone on a mortgage, we pull their credit score from the three credit reporting agencies, Experian, Equifax, and TransUnion. It's called a FICO score, and they give us a predictability of paying on time for long-term debt. And so that's really what your credit score is composed of. What a Vantage score does is it looks at alternative sources, things like rent payments, utility payments, cell phone payments, maybe even a Netflix payment, things of that nature that are more predictive of someone's everyday living, not just what reports to their credit. So basically it'll analyze different accounts that they have, whether they pay on time, whether they put them on automatic payment, things of that nature, and it'll give a combined score between what's reporting on credit and how they live their everyday life to be a better, what some say is a better predictor of how they're going to be able to pay for a mortgage. So it has some advantages for people who have lower credit because they've had a prior bankruptcy, or they have lower credit because they have, had a car repoed in the past, or something that takes a long time for their credit to recover from. It'll give us a more accurate pay history saying we don't necessarily need to hold that past derogatory credit against you at a 620 score. We can look at the Vantage score and lend based on how you live your everyday life. Especially helpful for people who have made different decisions or who have changed their lives financially. It could really help those people. It'll also help first-time home buyers, people who don't have a lot of established credit. If they've been renting for a year and they have been paying on their Netflix and they've been paying their utilities and everything's been paid on time, but none of that reports to credit, it'll help those buyers as well. Very specifically, right now I have a couple who's 19 and 20 years old, freshly out of high school, and they want to buy their first home. And so using what we call non-traditional credit resources to help them purchase a home is really the path that we go down.
Wow. Yeah, that's amazing. Good. I just wanted to update my memory as well as anyone
Yep.
that wasn't on that call. And then I got some information. I've been seeing some emails regarding putting the limit on, the cash purchases or trying to give the first-time home buyer the opportunity before corporate or these smaller investors come in. I heard a date of March 1st. Have you heard anything about it being put into effect? And maybe that was just the training. Do you know approximately when that might take place or when they're going to be talking more about the timing?
I don't, I have actually, that's the first time I've heard anyone actually say that there's going to be or some sort of legislation or anything put in place to limit who can buy what property. I do know, I think we had talked about it happening in New York, with that whole process.
Mhm.
But I haven't seen that roll out to any other states or any other opportunities. It might just be them, NAR encouraging realtors to encourage their sellers. However, from a pure lending standpoint, we
Okay.
cannot prefer someone lend. We can't prefer lend over anyone else, whatever that is. So I'm not sure how much regulation there's
Mhm.
going to be to that or how much you could get away with in that capacity because there are obviously discrimination and lending laws and things of that nature that might prevent that from happening overall.
Yeah, it seems like there's still a lot to be figured out. But
Yes,
yes.
as always.
Right. And then all of a sudden it's like, oh, it's happening. So no, that's why it's so important to get to these calls. Nikki, this is
Yeah,
amazing. I think I say that every call, and I say that every call, but it truly is like what you bring to this call and the awareness and everything that is coming. It's going to be something I'm excited for 2026.
me
I'm
too.
excited for everything that's coming, and I really, yeah, this is good information as
Yeah.
always.
And we've definitely seen an uptick in loan applications over
Mm,
the last week as well, which is good to see.
yeah.
With the interest rates just kind of stabilizing into that 5%, five range. You know, it's nice to see those applications picking up as well.
Yeah, absolutely. Well, I know in Minnesota here, we usually have the spring market hits right after the Super Bowl, which should be when we're out of the sub-zero temperatures too. So let's go.
Hopefully.
Right. All right. Well, appreciate you. Thank you for showing up as always. If
Absolutely.
anyone listening, either the podcast, social media, YouTube, where do they find you?
In Instagram and TikTok at Mortgages from MN to AZ, otherwise on Facebook under Nikki Erickson and on LinkedIn as well.
Perfect. All right. We'll see you next week. Thanks so much.
All right. Yeah. Bye.
Bye.